Good evening, everyone, and welcome. Thanks for joining us. The great rate debate intensified today as some of the most powerful people in monetary policy gathered in the small and beautiful town of Jackson Hole, Wyoming. This afternoon, the minutes of the Federal Reserve's last meeting were released in Washington, showing that some officials think the economy is getting better quicker, so much so that the central bank will need to hike rates sooner than planned. The initial reaction in the stock market was one of concern, and stocks shed some of their gains for a short time before they resumed their August ascent. Meantime, a CNBC survey shows Wall Street thinks the next round of interest rate hikes, whenever they begin, will be so gradual and so prolonged they won't end until the next president is in the Oval Office for nearly a year. Steve Leisman is in Jackson Hole, where Federal Reserve Chair Janet Yellen will speak on Friday with a look at why everyone from Wall Street to Main Street will be watching Jackson.
When the leading luminaries of the central banking and economics world converge on the Teton Mountains for their annual conference this year, there'll be three topics on the agenda: jobs, jobs, and jobs. The Jackson Hole meeting, to include the heads of the U.S., European, and Japanese central banks, is set to take a deep dive into labor markets. But it really comes down to a great rate debate between just two numbers: the 6.2% and falling unemployment rate, and the zero Fed funds rate, which hasn't budged in almost 6 years. The key question for the Fed is its easy monetary policy behind the curve of the job market and the economy, risking inflation down the road.
The labor market has largely healed. As you see, employment is back above trend in both services and manufacturing. Today's Fed policy seems not only unnecessary, but fraught with unappreciated risk.
The work of Princeton professor Alan Kruger will loom large at Jackson Hole this year. Kruger, who was invited but couldn't attend, has argued that the labor market is far tighter than the Fed believes, risking inflation. That's because millions of Americans who are long-term unemployed and who have dropped out of the workforce, he believes, are not coming back to work.
It's long-term unemployment which remains high, and in my view, the evidence suggests that the long-term unemployed exert relatively little pressure on the labor market, that many of them, sadly, give up searching for a job and eventually withdraw from the labor force.
Fed Chair Janet Yellen knows of Kruger's work, but has politely dismissed his conclusions.
I think it's premature, frankly, to jump to that conclusion that argument is correct. And I've made some arguments in other remarks that I've given about why I think that the long-term unemployed are likely to move back more actively into the labor force.
Yellen got some backing in the most recent jobs report, which showed 330,000 people came streaming back into the workforce for the third monthly gain in a row. And wage gains were muted. At issue in the great rate debate, when will the Fed start hiking rates, and how far will they go once they start? Judging by years past, when these leaders meet under the Tetons, big things happen. So this year, while it's all about labor, it's really all about interest rates, markets, and the economy. And that's why Wall Street will be listening very closely. For Nightly Business Report in Jackson Hole, Wyoming, I'm Steve Leisman.
With us now to talk more about all of this, Josh Feynman. He's Chief Global Economist at Deutsche Asset and Wealth Management, and Jim Paulson, Chief Investment Strategist at Wells Capital Management. Jim and Josh, thank you so much for joining us to talk about this very fascinating debate. Josh, let me begin with you. What do investors and business leaders need to hear from Janet Yellen on Friday?
I'm not sure what they need to hear, but I think what they are going to hear, as Steve pointed out, is a big focus on the labor market, that progress is being made, increasing confidence at the Fed that progress can continue, but we're not there yet. That there's still slack. It's too soon to throw in the towel on the long-term unemployed and those who've left the labor force. The Fed would like to give these folks as much of a chance to repair the damage from the Great Recession as possible. So while the Fed, I think, is increasingly getting their heads around the idea that economic conditions will justify them starting rate hikes next year, I think they're going to want to move slowly and cautiously. They don't feel any great sense of urgency, and they'd rather err on the side of, as I said, giving the economy more chance to repair the damage rather than moving prematurely.
Jim Paulson, today a lot of people, my humble little self included, read the Fed minutes and found them to be maybe a little more so-called hawkish than some people in the market had anticipated them being. Did you read them that way? And if you did, Why did the stock market move higher by the end of the day? Is the stock market being naive?
Well, I did read in the same way, Tyler. I thought it was more hawkish commentary than we've seen from the Fed. And I think the market looks at it a couple different ways. I mean, on the one hand, the fact that even the Fed is becoming a little bit more hawkish in their comments suggests that even they are seeing recovery going on in the economy, which really is a good thing. Even they now have confidence in the future of the economy. And I think that's good for the market overall. What the market wants to see is that the Fed also sees improvement, but not to an extent that they have to panically move up the timetable for rate hikes. And that's what I think investors will be looking for in Jackson Hole commentary. Is there a move afoot that we might move that first rate hike up from sometime next summer, maybe up to the first quarter of next year? That would be more concerning for the markets overall.
What do you say about that, Josh? Because in those minutes, it said some members want to move more promptly. Most members were going to be more gradual. What is the risk if the Fed misses the right timetable?
Well, I think there is a more active debate going on within the Fed, and it reflects that we are getting closer. But I think the center of gravity of the committee, Yellen and others around her, are likely to be a little bit slower. They just don't feel that there's this sense of urgency. Inflation is still very subdued. Wages are extremely subdued. They still believe there's slack, and they just feel that it would be imprudent to move too quickly. Now, of course, the economy will be the ultimate arbiter here. If it starts to show signs of overheating, of course the Fed would get going more quickly. But I think the risk of that is still fairly remote. Mm-hmm. And I think more likely the Fed's going to move, that summer timetable maybe, and then just move quite slowly thereafter.
Does it really matter, Jim, whether to the economy and not just to traders in the marketplace, whether the Fed raises interest rates in June of next year or April of next year or August of next year? Does 2 or 3 months really, in the grand scheme of things, matter to anybody but you guys who want to trade?
I think there's truth in that, Tyler. I don't really think that is that critical beyond the trading headlines it creates, the volatility short term. But like Josh said, ultimately it's not the Fed's decision. It's going to be the Fed's bosses' decision, and that's the economy. And I really believe that with the unemployment rate likely to drop into the 5s here very soon and the capacity utilization rate likely to go over 80%, we are just one hot wage number or one hot inflation report away from the economy, the boss of the Fed, telling the Fed and the financial markets, hey, we got to move this thing up. And I think that would be concerning, is not so much when they do it, but if they have to do it more aggressively and quicker in terms of magnitude, that would have to force investors to reprice assets on a different rate schedule.
All right, to be continued. Thank you so much, gentlemen. Josh Feinman of Deutsche Asset and Wealth Management and Jim Paulson from Wells Capital Management.